Good day. Ira Epstein with your agriculture wrap-up, and this is for Tuesday, the 18th of February, 2020, and we're right now just after the 2 p.m. time frame. So in looking at the markets, if you take a look at where we finished, this is the market that caught on fire, wheat. Apparently it had a lot to do with the fact that China's lowering another 600 and some odd tariffs effective March 2nd. Wheat might be in that grouping, and the market took off. Wheat is the highly volatile grain. It moves around like in the old days of pork belly did. Beans were still down a little bit, meal up a fraction, sugar market up, and if you look at the corn, well, you were sitting here in the corn up 5.5. So the question is the market trying to make lows here, or is this the bounce that gets sold again in the market? That's going to be the difficult part. We walked in and you were down hard in all the energies. I was on Bloomberg first thing this morning, and I am not in the school of thought that the world is ending here. I am in the school of thought that the virus, as bad as it is, and it is bad, the world comes back to work. And I see demand creeping in there. In the stock market, we saw Apple say that its earnings were getting hurt. Yet, here you are up 17.5 points in the NASDAQ. You're 130 points off the low in the Dow. You're barely down. I mean, it's just a normal day in the S&P. When you look at gold, though, gold exploded to the upside, and so did the silver market, the copper market, the platinum, the palladium. So the world is thinking people are going to go back to work. I just got to mention it that way. If we look at the weekly chart of closes, we've gotten a little bit of a bounce off these most recent lows. Yeah, today we're down. It's the first trading day of this week. Even though it's Tuesday, we really weren't open yesterday. Down 1.5. Okay. Resistance up at the 908 level to get this market being more bearish. Do you see this break low we had here? And I'll take you to it on a closing basis. It's the 872.5 level. Now, if that price is taken out, I think you're going to get a lot of traders' attentions to the downside. So what I think has happened here is the market's trying to form something of a trade low at this point. Doesn't mean it's bullish, just something of a trade low. When we look at how the market's been working, well, today was an outside day down. It means you took out, let's go to Friday in this case, Friday's high and low, you closed lower on the day. I would not want to see, if I were bearish this market, today's highs taken out. Why? Because when you take out the high of an outside day down, you often go to the closest of a key moving average, in this case the 18 or the 100 or a Bollinger Band. Let's put the moving averages on. First, I'll put the swing line on so you can see that. Now I'm going to put the averages in place. Well, they're far away. You've got your 100-day average here. The 18 is under the market. If you take out that high, there's a big gap in there. So what's another number that could come in? Here it is, the Bollinger Band. And it's falling to the tune right now of about 4 or 5 cents a day. Do you see that? So that's going to put it tomorrow around the 914, 15 area. I'd be looking at that as the more likely resistance if, and that's only if, today's high is taken out. If you continue down and take out today's low, well, you've got in play possibly the 882.5 area. In other words, it's a chop right here. And you can see how the market, even though it had a reversal down, it refused to close under the 18-day average of closes. I'll call myself neutral here. In the slow stochastics, you have momentum that is flattened out. So I have bias up since I'm over the 18-day average. I have no swing line. I have Bollinger Band resistance here and support down there. It's a chop city. In the meal market, if it can take out this 294.50 level, that's going to be the key to it if it's going to have another leg down, in my opinion. That doesn't mean I'm right if it takes it out, but that would give you and keep in place the lower highs, lower lows. What negates this pattern? Taking out 299.40. If that's taken out, you break the pattern of lower highs, lower lows. What's the battleground? Are you looking at the 18-day average? Look at how often it's been hitting it. That's your battleground in the market. Now you have a little bit of divergence going. You finished today at 297.60, right on the 18-day average of closes. Momentum, however, is up with the swing line down. I think tomorrow's going to be bracketed by 299.40 to 294.50, and which way it does there gives us an idea of what the next market play could be. The market that's still looking bearish is soy oil. It still has the lower highs, lower lows. Momentum is flat to lower, and bias is down. This is still the most bearish of the group. If the market were to get back over 31, 38, it would break the downtrend, but it cannot start an uptrend because you'd end up with a lower low and a higher high. In the corn market, you rallied right back to this red line, this 18-day average, that line in the sand. This is where the market's fighting a battle. Now, going home, the market, in terms of momentum, you saw it turn up. The bias is still down because you're under the 18-day average, or literally right on it on the close. And if you take out 387 3/4, you end up with a lower low, higher high, which could set up a rally back into the 100-day average in the upper Bollinger Band. Again, one of these days where you come back from a elongated holiday and the market's trying to figure out what it's going to do. The market that said what it's going to do is wheat. The wheat market tried to make a run towards the 100-day average. It certainly hit the Bollinger Band, and when we got through today, and I want to point this out, once you got through 550.5, this market was just gone. You have established higher lows, higher highs, and with the settlement over the 18-day average, the trend turned up, the bias turned up. Now, if the market wants to capture some people and accelerate to the upside, well, the upper Bollinger Band in that 577 3/4 zone, that'll drop a little tomorrow, but that's it. And if it pulls back to consolidate, I'm looking at the 18-day average. What would be the most confusing thing in the chart is if you took out the lows of Friday, because then I'd be scratching my head with this higher high, lower low pattern. I don't see that. In the sugar market, I think a move under 1450 can be the end of this wave to the upside. First, that would break the pattern of higher lows, higher highs. Second, I'm still looking for that seasonal to kick in if it's going to go to the downside. Third, we've run into lots of resistance, that upper Bollinger Band that we can't get away from. And fourth, look at how you keep holding that 18-day average of closes. Now, there is divergence here. You've had momentum pointing down a bit. You've got the bias up, and you've got the swing line to the upside. 1450 is a number that I think very important on the chart. In the coffee, I don't know that you have to hit this area here. We were looking together last week when you lost the embedded reading, and this was Wednesday, here's Thursday. That to me was the sign, this is all that I thought the market owed, was when you lose an embedded reading, get back to the 18-day average. Now, if it keeps going, then I'm going to look for the next resistance points, which on Thursday was a combination of the upper Bollinger Band and the 100-day average. I bring you into Thursday because, you know, on Fridays we do the weekly charts. This is what Friday's action looked like on the daily chart. Do you have to get up there? Don't know. You're already approaching an area here at the close of business Friday where you're getting close to overbought. You didn't quite get overbought today because as you approach that area, you fell back and closed 250 lower. This has been one heck of a rally, but I got to break the news to you. You still have a pattern of lower highs and lower lows. So we've had if you will, a rally in an overall bearish market. If the market breaks from here, I'm going to look for support at that line in the sand, that 18-day average of closes. In the cocoa market, you stepped out of your uptrend. Here's what the market looked like going into Friday. Higher lows, higher highs. If you break down under 28.48, what happens is you lose that pattern. Now you got lower highs, lower lows. Admittedly, the market's got momentum turning down, and the 18-day average is near-term support. Looks to me like a distribution top, unless I have reason to believe otherwise. You'd have to get through last week's high to make me think that's the case. In the cattle market, have we seen the break low? Possible here. This low is going to be a very hard low to break again, in my opinion. If this market takes out today's highs, what's going to happen is you can end up with higher lows, a higher high. You could be over the 18-day average, and you have momentum up. That puts into play the possibility of getting to the combination of the 100-day average, the upper Bollinger Band. If you pull back, I don't see a change on anything. Let's assume it just opens lower and stays under the 18-day average. You're still going to be looking at that 121.17.5 area no matter what tomorrow. So I know what I'm gearing on in that market. In the hogs, you're out of that downtrend, but I've said you've been out of it. when you lost the momentum back here. Do you remember when we talked about this? This is February 6th. It seems so long ago. But when you lose an embedded reading, often price and the 18-day average make a run at each other. What I don't like is if time goes by, a lot of time. It generally happens in fairly short order. This was not short order, not even close. This is a market that, as it's doing this, the 18-day average is falling. So even if it hits it, from the day that you lost it, the market really didn't make any upward progress. That doesn't mean down the road it can't make progress, but right now the resistance is 66.22.5. You have momentum up, bias down because you're under the 18-day average. The chart is trying to twist itself back up, hasn't succeeded. So when I look at all this, you put it together, well, today's one of those days where I often attribute the day after coming back from a holiday, one of those days you have to be somewhat careful in the markets. And that brings us into these crazy stock indices and trading. You know, on a day like today, I know a lot of traders that don't want to take on full-size contracts. They might want to nibble into what we call these mini stock indices. And they're 1/10 the size of what you are in a regular stock index. What do we charge? $1 a side plus the exchange NFA fee. Not a bad way for you if you're looking to get started to take a look. How do you do that? Go to our number, call us. But if you wanted to, you can go to this page. Just type in our address, but be sure you put in /micro because that explains how the mini stock indices work. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.